Hi, everyone. Today, we're diving into the mysterious world of Seller Discretionary Earnings, or SDE. You've probably heard this term thrown around a lot talking about business valuations, and many sellers use it on Biz Buy Sell. But what's the real deal behind it? Why do sellers and brokers love using SDE? And what does it mean for you as a buyer? Let's unravel this together. Now, if you like where this is going, make sure you hit the subscribe button. All right, first off, SDE tends to be larger than EBITDA or net income. That's because it includes not just the business earnings, but also the owner's full package. That includes salary, benefits, and a few other extras. This number makes the business look more profitable. It's pretty common to see a net income of $300K and an SDE of $500K. This is the number the broker bases the valuation on. And you could see 2x of a 300K is a lot different than 2x of a 500K. SDE is quite a bit different from the net income or EBITDA. That's earnings before interest, taxes, depreciation, and amortization. EBITDA is a more common earnings measure for larger businesses, where the owner's involvement is less critical to daily operations. So that's the secret of the SDE number. It's the key involvement of the owner because it's an SMB. I want you to stay to the end because I have a video from Heather Endresen, an SBA lender who's done over $500 million in SBA loans, and what she thinks about SDE. So what's inside SDE? SDE represents the total financial benefit that a single full-time owner-operator would derive from a business on an annual basis. The purpose of calculating SDE is to show that the true earnings potential of the business to a potential business buyer or investor. It's a way of normalizing the earnings to show what the new owner-operator could expect to earn from the business. And that includes, number one, net profit. Net profit, that's the starting point for calculating SDE. And it refers to the earnings of the business after operating expenses have been deducted. And then you have number two, non-reoccurring expenses. One-time expenses that are not expected to continue in the future are added back. These can include expenses like litigation costs, large one-off repairs, or expenses related to a non-reoccurring event. Then you have number three, discretionary expenses. These are expenses that benefit the business owner but are not essential to the operation of the business. Examples might include travel and entertainment expenses, donations, or sponsorships that are more of a personal in nature. Number four, on top of that, is depreciation and amortization. When the seller adds all these add backs in, it boosts the SDE and raises the multiple, which is the price they want you to pay. Your job is to identify those add backs if they're legitimate or not, because they're going to get kicked back by SBA underwriting anyway. So your goal is to bring a clean deal in front of the SBA lender. Write this down. Here's a rule of thumb. If the expense is going to be there next year, it's not an add back. Another way to say that is if a one-time only expense shows up on a company's income statement year after year, they are not one-time reoccurring. They are the opposite. They are recurring and they are not legitimate add-back expenses. So let's take a look at some not legitimate add-backs. And when I say these, apply the rule every time in your head. 100% owner salary. Really, is the business going to run itself? Now, you could see where a $2 million business and the owner is taking $500K and adds back a portion of that. Say it's competitive salary. That's legitimate. A one-time marketing campaign. Apply the rule of thumb every time. Is it going to be there next year? Maybe not, but it's a marketing campaign that he tested. That's the cost of doing business. Or tried this software and it did not work out. You tried it, but it did not work out. That's the cost of doing business. Legal fees. Now, if he's paying $5,000 a year, that's a reoccurring expense that's going to be there next year because you're still going to have legal fees. License and tax. Normally, business license are reoccurring expenses and would not be added back. What about clubs like hunting, country, health, and so on? Apply the rule of thumb there. That may not be a cost to doing business and may be legitimate. Auto expenses. Well, if he's running trucks and they're going to have that expense here, that's legitimate. But if it's a personal vehicle, that's not legitimate, right? Accounting fees. Are you going to have accounting fees next year? Apply the rule of thumb. What about travel? This is one that often comes up under the category of personal expenses that are run through the company. But just because it's common doesn't always mean it is 100% legitimate as an add back. Many times we see that travel is actually related to a trade show or conference, but some personal travel is added to it, meaning that they attend the trade show but extend the stay for personal vacation expenses, the whole thing. You can do that. It's your business. That's your prerogative. When that's the case, you need to consider the fact that if the trade shows were necessary for the seller, they will be necessary for you. I recommend you determine how much of the cost would be incurred for the trade show alone, and then adjusting the add back to eliminate the excess. If that happens, you'll find that a majority of the travel cost is a real expense. You'll have to stay at a hotel and you'll have to eat. So the add back will be significantly reduced. What about high-end office furniture? Apply the rule of thumb there. What about sponsorships of personal interest, like if a Ford dealership wants to sponsor a school, but there's no relation to the business? What about a family member on payroll who doesn't really do any work? Is that a legitimate add back? Most likely, because they're not going to be there next year. What about insurance? Often the owner of a small business will have a life insurance policy on himself that is paid for through the business, and that's sometimes referred to as key man policy. May also have a very high or expensive health insurance plan for him or herself. These type of expenses would obviously not transfer over to the new buyer because you have to get underwritten for a new policy. And here's a funny one that I saw in a P&L on an SDE, mistress. Now, I reached out to the broker and I said, hey, did you actually see this line item here where it says mistress? They never responded, never called me back. So that was a dead deal. Overstating add backs can lead to an inflated view of the business's profitability. That's the problem with SDEs. Your job is to bring a clean deal in front of the SBA lender. So I want to go back to the SBA lender here and talk about the valuation, who really sets the selling price of a business. You may think it's the seller, but in reality, banks play a big pivotal role. Banks act as a guardrail in the world of business valuations. They assess the value of the business, that's in underwriting, based on its financial health and future earnings based on the past. This assessment often determines the amount they're willing to lend for the purchase, essentially influencing the final selling price. Why sellers may have this SDE and have a price in mind, it's the banks that often have the final say in what a business is truly worth on the market. Remember that video I talked about? Here is what Heather Endresen, an SBA lender that has completed over $500 million in SBA loans, said about SDE. What do you do with SDE? Because I always see brokers coach the seller to put lots of line items in the SDE to make it look bigger, to make the multiple look better.
Okay, I am so against SDE as any kind of metric. I'm just against it because forget the add backs. I'll get to that. But even if you have a clean, no add back deal and you're going to add in the seller's comp, but you're not going to take a salary for replacement comp and you're going to pay a multiple of the salary that you're going to need, that doesn't make any sense.
Yeah, it's going to run itself.
Right.
It's going to run itself.
Yeah. Right. It's going to run itself.
Yeah.
So you have to deduct. I mean, maybe the seller's taking a huge salary and you're going to deduct a smaller salary. That's fair. That's fair. But you have to deduct a replacement salary or replacement salaries. So that's one of the common pitfalls too. Sometimes you have a number of exiting sellers, maybe the spouse or maybe they have a partner, and you're going to need more than one salary to replace them all. So you've got to.
I think the IRS requires a nominal salary, by the way.
Right, they do. But but you just got to look at what market would be to for you to spend your time running this company, and you're not going to pay 4 times your salary. Who's going to take a job and pay 4 times their salary to get the job? That no one would do that. So
I don't know. Yeah.
no. So I don't like SDE at all. Add backs, oh boy, geez. I mean, every small business I've seen, almost everyone, they're playing games with the taxes, right? They want to pay for personal expenses through the business, and I think we've all just come to accept that. But it can go too far. It can just
Yeah. Like, I'll just give you a perfect example. Just this yesterday, had somebody reach out on Facebook. Hey, are accountants and attorneys' fees add backs? I go, do you think you'll use them next year?
yeah, right.
Yes. Okay. They're expenses.
Oh, I've seen things like, oh, well, this software didn't work out for us, so you can just add that back. We didn't like it, or what,
Yeah.
just
You
things like,
take the R&D tax credit. I don't care,
yes.
but it's
Well,
not an
we
add
made
back.
a mistake on this, but spending money on that, so you won't have to. I mean, you're going to make mistakes too, I guess. Yeah. So some of the add backs are just kind of silly, and I don't know why brokers don't do a better job of just, let's start with at least a reasonably clean, defensible set of add backs. Let's just start there.
That's insightful, right? Now let's talk about what the SBA does consider legitimate add back. Owner's personal expenses. Expenses that were run through the business but are primarily personal in nature, such as personal vehicle expense, personal travel, or other non-business related expenses. And number 2, one-time or extraordinary expenses. Non-reoccurring expenses that are not expected to continue, such as costs from a lawsuit, or a one-off major repair, or expenses related to a rare event. Interest expense. The interest paid on business debts is often added back since a new owner may have a different capital structure or may not assume the existing debts. Depreciation and amortization. These are non-cash expenses that are added back to the net income. Discretionary spending is legitimate. Expenses that are related to the business but are not at the discretion of the owner, like higher than necessary travel and entertainment expenses, donations, sponsorships can be added back. This includes any expenses or income that are not related to core operations of the business. For example, a loss from a discontinued business segment or income from an unrelated investment. Rent paid above or below market rate. If the business pays rent to the owner at a different rate from the market rate, an adjustment might be made to reflect what the rent would be at market rate. Now, it's important to note that while these add backs are generally accepted, they should be reasonable, justifiable, and properly documented. Overstating add backs can lead to an inflated view of the business, and it's not going to go through underwriting anyway. To be safe, apply the rule of thumb every time. If this expense is going to be there next year, it's not an add back. Hope you enjoyed this video. Make sure you subscribe. Take care.